Hello and welcome to a new episode of Under 360 English. Today we are going to discuss about the things you need to consider while you invest in a high dividend paying company. We all love high dividend yield company, right? Just like companies like Vedanta, Aurum Product, etc., because the dividend yield is nearly 20%. So now let's have a look on what are the main things you have to take into consideration while you invest in a high dividend yield company. So stay tuned, keep watching. Generally, investors to create a steady source of income with a lower risk appetite, they prefer always a high dividend paying stock. Certainly, the prospects of getting a steady income from the stock market, generally that looks very good, especially in times of market volatility and otherwise also, okay. But many times, beginner investors make the mistake of focusing just on dividends as a stock selection criteria. They will ignore rest of the vital aspects of the company. Now let's see what are the aspects and how to factor them into your stock selection category when you look for a high dividend yield company. The first thing is you should know about the company and the sector also. So while it's extremely difficult to know about the company and the sector that operates in, generally, it becomes more important that if the company belongs to a volatile sector, for example, sectors that are highly dependent on regulatory compliance like energy sector or pharma sector. So these are a few sectors where a single piece of news that becomes a stripping point for the fluctuation of the industry that will eventually affect the dividend payout. So there will be a higher probability of a fluctuating dividend payout. This year the dividend yield may be something like 15%. Next year the dividend yield may be nil. So this kind of higher fluctuation on dividend yield may sometimes trap you in that company. Along with the company's share price also will go down. Along with that, you may left out without any dividend for the next year. So make sure of the company you opt for, knowing very well about the sector and associated risks. Also, you have to make sure that select a company that is fundamentally strong and has a robust corporate governance framework and sustainably holds with the regulatory as well as their compliance standards. Second point you have to take into consideration is you should be careful about the companies with high debt. Some companies, they will borrow money from banks, certain banks, and they will take as loan and they will give away as dividends just to make sure that they have a acceptability in the market. They may feel that gives some positive vibe about the company to the investors. So if a company is paying good dividend payouts despite of high debt, then that's a red flag to watch out for. So many companies generally pay dividends using debt just to keep their stocks somewhat in the limelight. So debt is an extremely important indicator of a company's financial health. Never forget it. So you have to have an eye on debt to market cap ratio. So the lesser the ratio is, the more stable the company is. If the number is increasing or has been reduced over a period of time, understand that the company may not be a good one, though they are providing a very high dividend payout. In long run, debt generally impact the growth prospects or that may affect the profits, or generally after a few years that may turn off the dividends also. Third important thing is you have to look for companies with consistent dividend payout. Some companies, just to come into the limelight or just to gain the investor confidence, they will take loans and give us dividends, just like we have earlier mentioned. But giving dividend by taking loans will not be a sustainable option. If a company is giving dividends for the past 10 years or 8 years, though they have not having a good business model, that shows the company's consistency. So always look for companies with consistent dividend payout at least for the last 5 years. The fourth one, that's a general rule of thumb, that's never get fooled by high dividend yield. So generally, it's a very natural thing to get attracted to some stocks or shares with a high dividend yield. But a high dividend yield can be a misleading many a times. Not always, but many times. That may be a result of underperforming security, and hence it's no use if your capital base is depreciating. If already the promoters feel that anyway we are just going out, just in the case of our old Aurum product, the name was different previously. They have given out the entire capital itself as dividend. Company price was 1,000 rupees and they have given almost 900 rupees as dividend. That also may happen. If the promoter itself feels that the company is not worthy enough, they will give out as dividend, they will also take the dividend, and the company will become a shell. The fifth point you have to take into consideration is you have to thoroughly look at the payout ratio. The payout ratio generally indicates a company's capacity to support dividend payout. Mathematically speaking, it can be calculated by dividing the dividend per share by company's earning per share. Dividend divided by EPS. So the ratio is more than 1. That means the company is giving more dividends than its earning. And this poses a suspicion or a question about the company's long-term sustainability. So in short, while you select stocks, never take your decision just based on dividend payout alone. It is very important because many companies may not actually deliver in a very good way when it comes to operations or profits or their business models, though they give very good dividends. So, scrutinize, evaluate a company's annual reports thoroughly and factor it into consistent dividend payout, fundamental analysis you have to do, earnings growth you have to consider, and ultimately the business model and the management quality. These all factors only will give you a long-term prospects on that particular share. So that's all for now. See you in the next episode. Till then, bye from Manu.